What happens when the world's safest debt is no longer seen as safe, when the institutions that have long accumulated it, quietly, over decades, begin to reduce their holdings not in panic, but methodically, as if preparing for a shift that few others yet perceive? History offers no shortage of such moments, when confidence in a dominant financial instrument erodes not with a crash, but with a slow withdrawal. The illusion of stability for generations. Certain assets have been regarded as beyond question. They are held by central banks, sovereign funds, and conservative institutions as the bedrock of reserves. They promise liquidity in times of crisis, a reliable store of value amid uncertainty. In the early 20th century, British Consols perpetual government bonds occupied this position. Backed by the might of the British Empire, which controlled vast trade routes and a currency used across continents, these gilts were considered the ultimate safe haven. Foreign governments and investors accumulated them in large quantities, viewing them as immutable. The system appeared unbreakable. Trade surpluses flowed into London, and the pound sterling served as the medium for global commerce. Yet beneath this facade, strains accumulated. Wars, reconstruction costs, and shifting economic power gradually altered the calculus. Holders abroad began to question whether the yields compensated for emerging risks. The illusion held for years, reinforced by tradition and the absence of viable alternatives. But illusions, in monetary history, have a way of persisting long after their foundations have weakened. Historical case study number 1. The decline of sterling in the Suez crisis. Consider the events surrounding the British pound in the mid-20th century. After World War II, sterling remained a key reserve currency, second only to the emerging dollar. Foreign central banks and governments held substantial amounts of British government debt, trusting in London's financial preeminence. In 1956, a geopolitical confrontation over the Suez Canal exposed vulnerabilities. Britain, in alliance with France and Israel, sought to regain control of the waterway after its nationalization by Egypt. The military action provoked international backlash, particularly from the United States, which opposed the intervention. As pressure mounted, speculation against the pound intensified. Foreign holders of sterling balances accumulated through years of trade and lending began to convert them into dollars or other assets. The Bank of England faced relentless demands on its reserves to defend the currency peg. Britain sought assistance from the International Monetary Fund and drew on support lines. But the episode revealed a deeper truth. When confidence falters, even long-standing holders reconsider their positions. The crisis passed without immediate collapse, but it marked a turning point. Over the subsequent decade, foreign accumulations of sterling reserves declined relative to global totals. The pound's role diminished gradually, as alternatives gained ground. The loss was not in the events of Suez itself, but in the quiet reassessment that followed the recognition that imperial obligations and post-war debts had altered the risk profile of British assets. n.wikipedia.org, iwm.org.uk, thecollector.com. Historical case study. Number 2. The end of the Bretton Woods era. A more direct parallel emerges from the post-war monetary order established at Bretton Woods in 1944. The system pegged major currencies to the US dollar, which in turn was convertible to gold at a fixed rate. This arrangement positioned US Treasury securities as the premier global asset. Foreign central banks accumulated dollars and treasuries in vast quantities, using them to settle trade and back their own currencies. For 2 decades, the system functioned smoothly. The United States ran deficits to supply liquidity to a rebuilding world, and foreign institutions willingly held the resulting dollar claims. Treasury bills and bonds became the modern equivalent of gold, liquid, secure, and essential for reserves. By the late 1960s, however, persistent US deficits financed by overseas spending and domestic programs led to an overhang of dollars abroad. European nations, particularly France and Britain, grew concerned that the dollar supply exceeded America's gold stock. Quietly at first, then more assertively, they began converting dollar holdings into gold. The process accelerated in 1971. Foreign demands drained US gold reserves rather than a sudden rupture. It was a cumulative erosion. Holders abroad reduced their reliance on dollar assets, seeking direct claims on gold instead. The United States suspended convertibility in August of that year, effectively ending the fixed link. The aftermath saw floating exchange rates and a reconfigured monetary landscape. Yet the shift had been underway for years, driven not by speculation alone, but by central institutions reassessing the long-term viability of holding ever-growing quantities of one nation's debt. TheGoldObserver.com, CFR.org, BullionStar.com transition to the present. These episodes share a common thread with earlier monetary shifts, such as the gradual retreat from French royal debt in the 18th century. Under John Law's system, paper notes backed by Mississippi Company shares were embraced as a modern innovation. Held widely by domestic and foreign investors, confidence sustained the expansion until underlying assets proved insufficient. When holders, particularly abroad, began to redeem notes for specie, the structure unraveled, the pattern repeated: accumulation during prosperity, followed by reduction when imbalances became apparent. In more recent decades, the world's reserve assets have centered on the obligations of a single dominant economy. Central banks and official institutions have built substantial portfolios of these securities, viewing them as the safest and most liquid available. Yet history suggests that such concentrations carry inherent limits. When deficits accumulate over extended periods, or when geopolitical tensions alter perceptions of risk, holders may diversify not dramatically, but steadily. TheCurrencyCollector.com, Fool.com, the pattern recognition section across centuries. The decline of a dominant financial asset follows recognizable stages. First, accumulation builds during a period of economic hegemony when the issuing authority provides global public goods stability, liquidity, open markets. Second, imbalances emerge, persistent deficits, financed by foreign willingness to hold the asset. Yields remain attractive relative to alternatives, and inertia sustains demand. Third, a triggering event, geopolitical, fiscal, or monetary, prompts reassessment. Not a crisis in markets, but a shift in official portfolios. Central institutions reduce exposure gradually, diversifying into gold, other currencies, or domestic assets. Fourth, the process accelerates as liquidity thins and yields rise to attract remaining buyers. The asset loses its privileged status, not overnight, but through a multi-year transition. Fifth, a new configuration emerges, often multipolar, with no single instrument dominating as before. Trade adjusts, reserves diversify, and the former hegemon faces higher borrowing costs. This sequence appears in the retreat from Spanish silver in the 17th century, Dutch perpetuities in the 18th, British consols in the 20th, and dollar claims in the 1970s. The common element is not malice or coordination, but rational recalibration by stewards of national wealth. The psychological element, human behavior, plays a central role in these transitions. During accumulation phases, denial prevails. The system is deemed exorbitantly privileged, uniquely positioned due to network effects and institutional depth. Normalization follows. Minor reductions are dismissed as temporary, attributable to cyclical factors rather than structural change. Delayed reaction characterizes the middle stages. Holders maintain positions longer than fundamentals might suggest, bound by tradition, lack of alternatives, and fear of precipitating loss. Only when a critical mass shifts does momentum build. Psychologically, the turning point arrives not with alarm, but with quiet acceptance that the old certainties no longer hold. The silent phase. Perhaps most unsettling is the period when outward appearances remain calm. Markets function normally, yields fluctuate within historical ranges, and commentary emphasizes resilience. Beneath the surface, however, official holdings decline incrementally. Custodial accounts show outflows, reserve compositions adjust, and diversification proceeds without fanfare. This silent phase can endure for years, even a decade. Everything appears fine, trade continues, debt is rolled over, liquidity abounds. Yet the foundation erodes, as those with the longest horizons and deepest pockets reposition. In such moments, the absence of drama masks profound change. Observers debate short-term flows while missing the secular shift. Commons.wikimediae.org, alamy.com. BullionStar.com. Closing reflection. History records no empire or monetary system that endured indefinitely in its dominant form. Spanish reales gave way to Dutch guilders, which yielded to sterling, which in turn shared space with the dollar before adjustments ensued. Each transition carried costs. Higher funding rates for the former center, volatility during realignment, redistribution of economic influence. What prompts the stewards of global reserves to alter centuries-old patterns? Not speculation or caprice, but the patient arithmetic of risk and return over decades. In the end, the question lingers: when does accumulation become overextension? And when does quiet diversification signal the beginning of a larger reconfiguration? The historical record offers patterns, but no precise timetable, and the reminder that such shifts, once underway, rarely reverse.